Amy and I are really pleased to be here, and I'm going to start, and Amy's going to finish up. And what we're going to talk about is pensions and ESG, an institutional historical perspective. So this is not data driven. We're really trying to capture where did all this come from, and why are pensions important for ESG? Of course, it's not always been called ESG: responsible investing, sustainable investing, governance, environmental, social, and what we're keying off of is the a more recent statement from the United Nations Principles for Responsible Investing, which says that sustainable investing, or ESG investing, is we're on the second slide, is the strategy and practice to incorporate environmental, social, and governance factors in investment decisions and active ownership. The UN has been incredibly important in this, the UN PRI, but there are a wide range of institutions, not just investors, but independent organizations, governments, and others that are essential to thinking about and the development of ESG. The themes that we're going to be focusing on today are that first of all, the role of pensions. What we discovered in doing this work is that ESG, of course, has grown. It's really grown into its moment, but that pensions and what we call universal owners, and we'll get to that in a second, are critical to this. It's, there's been a kind of legal framework that's been put around this. Is, ESG develops differently in different countries, and it really depends on the legal framework. Well, I think what we're arguing is that until you get big pools of assets, i.e., institutions that own a lot of things in a lot of the world, the ESG has a very different character and much less influence. But when you start to get pensions and other universal owners, you see a big change in ESG. Next slide, please. So what do we mean? Well, this is a descriptive framework, not a normative framework. We're not telling you how this should work. Universal owners. A universal owner is a pension or another institution, because it could be somebody like BlackRock, that by intention or requirement, mainly because they're so big, invests long-term in widely diversified holdings throughout the global economy. And that puts a universal owner in a position of essentially having to deal with, or being incented to deal with, externalities, i.e., the effects that company businesses have on their environmental, social environment, and the governance system that helps connect the company to those externalities. So the question is, who's affected, and what incentives are there for a universal owner to act? The other issue is agency. So principal agent issues, which always sound good in theory, getting the agent, which is sort of the company, to do what the shareholders really want, which can be returns, but also could be an interest in externalities for the long-term good of the company. But the real question is, who are the stakeholders, not just shareholders in this thing, and who pays and who benefits? So what we see of ESG drivers is the economic transformation, even going back to the Industrial Revolution, but also the continuing economic transformation that has highlighted both the problems and the benefits of externalities, the rise of universal owners, which really is only the last few decades, stakeholder interests, not just shareholder interests, and improved data and analysis that Linda Ealing-Lee is going to talk about. And Amy is going to cover some modern influences, or the modern evolution, which is an evolution from principles to products to processes to outcomes to a whole system of ESG. And she'll talk about that in a couple of minutes. Next slide, please. So what I'm going to do is talk about how we got up to the modern era, and I'll try and do that very quickly. Because what was fascinating to us in doing this research is what were the issues in the beginning. Of course, there was no ESG. There was a lot of governance and some social stuff, and very little environment in the beginning. What we mean by the beginning is really the late 19th century through about 1970. And what you see is, in many countries, and this is not just the US, is concentrated ownership of public companies. As we know, the huge transformation of work and consumption, how things get produced or services get done, and then how they get used. Little to no small shareholder activism on social and environmental issues for the most part, and little to no pension activism because there weren't funded pensions. That's really critical, because if you don't have a funded pension, then you don't have a pool of assets with it that could provide incentives for action. So mostly this was government related. So policies to limit bank and family ownership and monopolies, antitrust, et cetera. The emergence in Europe of a two-tiered board structure, the first uniform accounting rules, the first formal recognition of stakeholder rights in Germany. And then we can't forget about government ownership of certain industries, such as pre-World War II Japan, but of course the Europe after World War II. Next slide, please. So what is the dawn of the modern era? We think that that's around 1970, but of course it's going to vary by country. And what do we see at that dawn? Well, we see that governance practices and policies vary by country. In the US, company management becomes dominant. And what's interesting about it is it became dominant because they got rid of family and kind of financial institution control of other companies. That was characteristic of the US and other countries. But the US's solution was to essentially put the control in the hands of company management. In some European countries, those older things persisted. And then, of course, in Japan, there's cross-holdings and bank influence. On social issues, there was the beginnings of more contention over social issues, such as the declining influence of unions, and so it didn't all go in one direction, but definitely a debate over employment and consumer and other kinds of social issues. And really everywhere there was very little interest outside the US in environment. The US EPA is really kind of and the environmental movement in the EPA is an exception. Next slide, please. So shareholding patterns vary by country, and I've highlighted some that are some of the biggest areas where you see pensions, funded pensions. But you can see, let's see. Oh yeah, keep clicking on this. Just go slowly. There's the U.S. Keep clicking. What we see there are countries where there's a lot of institutional investors, like pensions. Keep clicking. Now you see countries where there's less institutional ownership, but some. Another click. Another click. This is where you see a lot of public sector ownership. No surprise. And Norway gets counted as a public sector, even though it's really a pension. Keep clicking. And then again, lighter ownership. Again. And this is where you see a combination of private corporations and strategic individuals. I call it the Carlos Slim effect in Mexico, where you see a lot of private ownership. Okay, keep going. Yes, and so finally, what do we see in the modern era after this? What we've just seen is this ownership structure, and I think where you see pension ownership, which was the first thing the arrows we showed up, a lot of pension ownership and other institutional ownership. You see a lot more influence and activism on the part of big institutions to be involved in ESG. So in the modern era, ESG are initially treated separately. Then we see a convergence between them, and Amy will talk about that. And what are the important actors? There's social movements, government and regulators, independent advocacy and service organizations, asset owners and asset managers, and of course pensions being asset owners and sometimes asset managers as well. So Amy, let me turn it over to you.
Well, thank you, Brett. And it's really an honor to be part of this conference. And on the topic at hand here, I personally feel that 50 years in to the modern era, it is important to capture the history of ESG accurately and the key role that pensions have played and will continue to play in shaping ESG. So I'm going to spend what little time I have kind of breaking down the decades, the modern era decades on this slide 8. I think it's worth noting that the investor toolkit for E&S has largely fell into 3 camps throughout the modern era, which has been guideline investing, which has taken many forms over the years, from exclusions to product-specific criteria to the more modern concept of ESG integration across portfolios, shareholder advocacy, and community investing, which is then later, I'd say, more termed as impact investing. And I just, on a just personal observation, I mean, despite the significant and sometimes divergent stakeholder views on specific topics, think E&S has been very much viewed by pension funds and their trustees through the business case lens. Although I think it's been harder in some cases to make the business case. And I think a lot of pensions have really struggled, if you will, at the top level, at the board level, and finding that right balance between, social responsibility and the fiduciary duty to act to maximize return on behalf of our participants. I think it's also worth noting there's been some recent, coverage of the role of investors versus the role of government in addressing environmental and social challenges. This has also been a very much a theme for many decades here. And so what Brett and I landed on was trying to classify, each decade by, a theme. So moving from principle to practice to product to process to outcome and now to the systems level. And so we see a great amount of activity throughout the years in terms of how to measure E&S, particularly performance of portfolios, how pensions should take action initially on shareholder activism, how they should organize around building out capacity, which has certainly changed. And really, how do you move from, particularly on the ESG integration side, from portfolio approaches that were very product or carve out specific to portfolio wide. So I'll in the interest of time here, I'll skip to slide 10. We still have a lot of focus after all of these decades on ESG to what end? To enhance performance, to add alpha potential, or to mitigate risk. So I hope when we get into the discussion a little bit later, we can focus on some of these continuing challenges, which a lot of which are around who gets to decide, particularly when it comes to ESG performance, what's good, and really what is going to be the role of the regulatory regimes that we see emerging even more so in this space going forward.
Yeah, and how pensions fit into all that, right, Amy?
Exactly.
Yeah.